Hello children, welcome to the digital classes of Christ Church Convent Higher Secondary School Gadarwara. I am Amit toshniwal, your accounts teacher. This video is for class 12th. Subject is accountancy. Chapter number 11, financial statement of a company, part 1. Financial statements of a company. Each company has to prepare their final accounts at a specific period of time, a specified time. You remember, for sole trade and for partnership, for the partnership firm, final accounts are prepared at the end of a year. But for the companies, when they are working in a very vast way, means they are huge in size, means they are huge business organization, so they can make their financial accounts after every quarter, or say half yearly, and obviously at the end of year. So two financial statements are prepared by company, and they are: the first, statement of financial position, that is balance sheet, and the second one is statement of profit and loss, or we can say income statement. According to Companies Act 1956, it is mandatory for each and every company to prepare their financial statements. Financial year means the year which ends on 31st March. If any company has come into existence on 1st January, then it will prepare its financial statement for the period ending 31st March, even then. So for the companies, year ending is 31st March, not 31st December. What are the objectives of making financial statement? So the main objective is to provide information related to financial position of the organization, performance of the organization, and cash flow. So you can see on your screen now, the first one is knowledge of profitability of the organization. Profitability is a ratio which is found out on the basis of current assets, current liabilities, fixed assets, and fixed liabilities. So after every quarter, or at the end of year, company wants to know that how much profit is earned in comparison to previous years. So for this, financial statements are made. Second, effective use of resources, whether the resources employed with the company are working efficiently and effectively or not. So that can be measured through financial statements. Third is helpful in estimation of cash flows. Cash flow is the major part of any company. For this, company issues different type of shares that you already studied in previous chapters, as well as debentures of different types. So in what way cash inflow and cash outflow of company makes, so this can be known through these two financial statements, statement of PL and statement of financial position, that is balance sheet. Help in comparative analysis, yes. If financial statements are made, then company can compare its financial position as well as all kinds of profit like gross profit, net profit, operating profit, everything can be compared with the previous year's figures, and accordingly formulation of policies and new plans can be made. Fifth is information about important business activities. So what are the important business activities? There are three types: operating, investing, and financing. So three activities are involved with the company. So what activity, what is the outcome from which activity, it can be known through financial statements. Sixth is to know the effect of operating profit of the organization, about which I already have dealt in point number 5. Now, utility or the importance of financial statements. There are two users of financial statement of a company: external users and internal users. Internal users means the shareholders of company, employees and board of directors यानी कि management. And external users are debenture holders, investors, bankers, government, different departments of government and creditors. So each of them wants to know whether the company is growing or depleting. Financial statement present a clear picture, means the current scenario of financial status and financial position of the company. So we'll deal all these one by one. First, shareholders. Yes, because they are the real owners of the company. They invest with the company in form of shares, and they expect some dividend, bonus and profit out of this. So if they are given proper information about financial state of the company, then new shareholders can be attracted to purchase the share of company. So it is very useful and important to make financial statements for them. Second is for debenture holders. Debenture holders are those persons who are giving loan to the company in parts. I mean to say, the company owes these persons. Means in previous chapters we already have dealt with these topics. Then no company can issue its share more than its authorized capital, and when it is bounded not to issue shares, then this is a different tool to arrange funds to issue debentures, for which company issue debenture, and it offers public to purchase the debentures. So if debenture holders are well aware and they know the financial status of the company, so they can easily provide the loan to the company. Then third is investors. Investors, the above two mentioned shareholders and debenture holders are only the investor of the company. They invest their money with the company. Apart from them, any other company wants to invest in some other company as reinvestment or as a security, or else any multinational company or foreign company can invest with any company. So these are the investors. So when they will take an intention to invest their money with the company, when they are well aware and well known to the financial status and financial position of the company. Fourth is for employees. Definitely they are the very vital part, means they play the major role to for the upbringing of company. They have worked hard for the company day and night, and then company takes a shape and it grows. So when they are known that company is growing and it is financially sound, then they can expect better future for themselves, and they can demand for their salary, bonuses and other facilities from the organization and administrative body. Okay. Next is for bankers. Bankers cannot provide loan to any of the company until and unless they are shown certified and audited financial statement before the banks. When banks satisfied with all the financial statements presented by the company, so a company can get loan easily from the bankers. Then for the government always keeps an eye, and for which it is means government has established different types of department and boards to keep a keen eye on the working and activities and functioning of the company. So government can impose different types of taxes. In case of foreign trade, how means what relaxation has to be given and what restrictions has to be made. Moreover, in what amount the different taxes like import duty, export duty, custom duty, excise duty, corporate tax, sales tax and other tax has to be levied on the companies. It is decided by the government after seeing the financial statement of a company. Then for SEBI is that is Security Exchange Board of India, which works in India for the registration and for the observing the functioning of companies. So when SEBI knows that any company is doing well, then it can suggest to the public to invest their money with that company. And moreover, if any banned activity is being done which is prohibited for the companies, then SEBI can take an interference. It can intervene in the function of in the functioning of the company. Then for management, definitely, because management is the one who is making all these. So if management knows about its financial position, then they can plan for the future, then how to grow the business, and they can make plans for future. For business creditors, definitely creditors means those who are giving money, they are lending money to the company. So when they will give, when they come to know that company is sound enough financially. And the last topic of this video, limitation of financial statement. There are some lackings which financial statement cannot present. So what are they? The first is lack precision. It means facts and figures or financial statements cannot be presented with high precision. तो ये possible नहीं हो सकता इसमें. Next, only monetary information included, that is quantitative, not qualitative, like the honesty of any employee, hard working, dedication, devotion, and whatever qualitative measures are there, they are not taken into consideration when financial statements are made. Based on past events. Why past event? Because about future we can make only estimations. So whatever had happened during business activities of all types, operating, financing and investing, about which it gives only the necessary information except the future ones. So this is a drawback of it. Window dressing. So window dressing means if it is not all mandatory and necessary according to Act or SEBI, then companies are not bothered to make this. So they are doing it just for the sake of their own selfishness, otherwise they won't do. Limited scope. For the other activities, there is a wide they do much for economy, for the society, for the politics, and for the country, but all these transactions are not recorded with the company by the company in their financial statement. Therefore only financial transactions are recorded. Limited time period. So nothing can be said for sure about its authentic whether they are authentic or not. So there are means they have got a limited period of time. So in any time company can perform well, and in the time of recession its performance may be poor. So that cannot be known by seeing the financial statement. And the last is personal conclusion. When conclusions are drawn from the facts, so financial statements are dependent on personal assumptions and personal knowledge of the user. Otherwise, they are unuseful. They cannot be taken in use. So these two topics, utility and limitations, are important. Every year, alternative year, they come into the examination for 4 to 5 marks. So you learn these two questions very well. Thank you.